A very warm welcome to you. Good morning, wherever you find yourself. And thank you so much for joining us here for the Industrial Funding and Incentives webinar, a hugely anticipated program. And we really want to extend our gratitude for the interest that you've shown in this particular program. My name is Cindy Mabi, and I'll be your host for this session. Let me also proceed to introduce our speakers for today. Ms. Tshepiso Makgoti is the Chief Director, Strategic Partnerships and Customer Care at the DTIC. And Mr. Ondela Hlwati is the Account Manager, Financial Services Partnership at the IDC. And Mr. Andile Stemela is the Strategic Projects Fund Manager for the NEF. Just to give you a sense of why we are here on this online platform and the objectives behind it is essentially to talk about access to funding and transforming the economy, especially in high-tech and high-growth industries, and to create awareness of the funding opportunities available for SMEs and highlight the funding and support policy strategies and prescripts associated with the compliance for each organization, and to educate business people on the eligibility criteria, what you need to know and what you need to have in order to access the funding, and to foster economic recovery. If you look back at July 2021 with the civil unrest and the protests that had vandalized and damaged many businesses, these agencies present today, and not limited to the agencies here, have been instrumental in creating stability in those businesses, to restore their operations and to save jobs as well. So this platform is essentially to create an opportunity and a participation for businesses and funding institutions to then access opportunities and extend the programs to yourself. So without any further ado, I'd like to ask Ms. Tshepiso Makgoti. Good morning to you.
Good morning, Cindy, and to the attendees. My name is Ondela Hlwati. I will be presenting the special funds which are managed by the IDC. Yeah, can you go on to the next slide? Thank you so much. The first funds that we are looking at, it would be the MCEP, the main funds. With the MCEP, we have the MCEP main fund, we have two facilities there. It would be for plant and equipment. The major objective of MCEP is to provide concessionary debt funding to manufacturing companies in a form of plant, equipment, as well as working capital. So for plant and equipment, it is only available to Black industrialists, manufacturers within the SIC code 3. It's available to both startups and existing businesses. During the term of the facility, the clients cannot retrench any workforce. It is leveraged with IDC. We partner with our stakeholders in that IDC co-funds with them at 20% with a minimum of 20% IDC funding. Business support is also provided at a maximum of 3 million. The maximum that we can fund on MCEP is limited to 30 million per applicant. We want these funds to assist as many businesses as possibly can. But 30 million is actually a prerequisite number. And then it's debt funding, which is priced at a fixed rate of 2.5% for the term of the MCEP facility. The maximum term for plant and equipment is 84 months. That would include the moratorium. The first draw for plant and equipment needs to happen within 12 months from approval. So we do charge standard IDC fees on MCEP. However, raising and commitment fees are excluded. Similarly, with the working capital, the major difference between the working capital and plant and equipment would be it's available to also non-BIs. It also has a SIC code 3 startup and existing companies. Also, it does not allow for retrenchment during the term of the facility. At least a level B a level 4 of BEE within 24 months. It is also leveraged at least 20% from IDC. Business support is still limited to 3 million, and it's also limited to 30 million per applicant. The debt is also priced at 2.5%. One of the differences between the plant and equipment is the term. For working capital, the term is 48 months, and the first draw needs to happen within 6 months of approval. The reason for the short timing on these, in terms of disbursements, we want the money to be dispersed and it moves into the economy as quickly as possible. Thanks, Klops. Let's go on to the next one. And then our next MCEP program is the MCEP Economic Distress Program. It's to support companies that are in distress that will adopt a bankable turnaround strategies. So it's for both plant and equipment, as well as working capital as well. This facility is available to companies that are financially distressed and not as a result of deep or structural issues, mismanagement, or operating inefficiencies. The support is provided to a company which is unlikely to pay its debt as they become due and payable from the upcoming 6 months. It's available to companies that are unable to fund their operating activities within the immediate ensuing 6 months. It's also available to companies with a sustainable business plan, with the support provided that the company must show that it can recover. So that's very important because if it cannot recover, it means that the IDC and the DTI will not be able to get their money back, and to also assist other companies as well. So it must demonstrate strong business fundamentals, experiencing temporary credit difficulties. Assistance cannot be open-ended. Therefore, interventions must show that the business can recover within a reasonable time frame. And the reasonable time frame that we've looked at is between 18 to 36 months. Distress funding that is injected cannot be applied to relieve shareholders and other financiers. Support will be provided to companies in distress, adopting a turnaround strategies that will lead to increased localization of production activities within the value chain. They're promoting economic inclusion through meaningful ownership by workers, women, youth, and people with disability. We encourage companies with broad-based beneficiation. There should be no reduction. There should be no reduction on the current workforce during the term of the facility, deferring the payment of directors' emoluments. So directors' emoluments cannot be paid during the term of this facility. Also deferring payments to intercompany, transaction-connected companies, and payments of royalties. So salaries of executives and senior management should not be increased during the term. And therefore, the enhancement of management capacity and expertise is also supported by this facility. Okay. And then another facility within the MCEP stable is the Economic Stabilization Fund. It's aimed to provide funding to companies that have been affected by the unrest and associated supply chain disruptions. As you've mentioned, Cindy, in your opening remarks, is that the unrest did cause economic turmoil, and the IDC and the DTI partnered together to set up this facility in order to assist companies that would have been affected by the unrest. So the size of the facility is 900 million. It's available for bridging facility, working capital, plant and equipment, and building or building improvements requirements. Companies have to be operational for at least 12 months. So it won't fund new companies because they would not have been affected by the unrest. So it's applicable to manufacturers. However, non-manufacturing companies may be considered, such as retail and non-manufacturing companies associated with supply chain disruptions. So it is leveraged with IDC funding at a maximum of 50-50. So IDC is also coming to the party here with their contribution. It's available to all provinces, not only the mainly affected provinces by the unrest. So there is no retrenchment during the MCEP facility. However, should there be compelling reasons, this may be considered. The reasons need to be really compelling. So the company would need to demonstrate indirect jobs through supply chain or re-employment at a later stage. The support is provided to companies that are fully insured, underinsured, or uninsured. Loans may be converted to a grant provided that the business will maintain the same level of employment the company had before the unrest. This needs to be achieved within 12 months after the first draw of the MCEP facility and is limited to 30% of the total funding of MCEP and IDC. Another facility that we are looking at is the MCEP Economic Job Creation Support, which is the purpose or the objective is to provide concessionary debt funding to manufacturing companies that create jobs. As the name itself, it's all about job creation mainly. In a form of plant and equipment. It's available to BIs, manufacturing companies, startups, and existing companies. There's no retrenchment during the term of the facility. It is also leveraged at least 20% from IDC. Business support is also provided at the maximum of 3 million. It is limited to 30 million per applicant. Debt funding for this facility is priced at 0% for the duration of the MCEP facility. The maximum term is 84 months, which includes moratorium. The first draw needs to happen within within 12 months from approval. Is for existing companies. For existing companies, a loan is limited to 30% of the total funding from MCEP and IDC, kept at 3 million. This may be converted into a grant for companies that demonstrate creation of at least 10% additional jobs within a period of 18 months after first disbursement. Raising and commitment fees are excluded. All other standard fees are applicable. And then in terms of MCEP economic job creation support, it's available to companies that are at least BE level 4 within 24 months, manufacturers with startups as well as existing companies, no retrenchment during the term. It is leveraged at least 20% from IDC. Also business support is provided at the maximum of 3 million. It is limited to 30 million per applicant. The debt is priced at 0% for the duration of the facility. The maximum term for the working capital facility is 48 months as well. So that includes moratorium as well. The first draw needs to happen within 6 months from approval. For existing companies, a loan limited to 30% of the total funding from MCEP and IDC, which is also kept at 30 million, may be converted into a grant for companies that demonstrate creation of at least 10% additional jobs. Also, raising and commitment fees are excluded, and all other standard fees are applicable. Another facility that we'd look at is the infrastructure program. It's available to companies that are affected by the unrest through the provision of grants for reconstruction of infrastructure. Again, this is in response to the unrest. Mainly, the fund size that we're looking at here is 400 million. It is provided to companies that are underinsured, uninsured, as a grant limited to 50% of the total qualifying infrastructure costs. However, it is kept at 30 million. It's available to companies that are fully insured as a bridging facility provided at 0% for 12 months. The bridging facility may be converted into a grant should insurance not cover the full claim. So support can be provided directly by IDC or through a strategic implementation partners. Companies are located in all South African provinces, so it's not limited to the the provinces that were majorly affected by the unrest. Another facility that we're looking at is the Downstream Steel Industry Competitiveness Fund. This is a steel industry fund. The objective mainly is to help struggling steel industry with interest subsidy that offers discount to qualifying clients. The fund size here is 1.5 billion. So it's available for startups as well as expansion or existing companies. Enterprises that create net additional employment are prioritized, particularly opportunities with greater labor intensity. In terms of the qualifying criteria, one of the following would applicants need to meet in order to qualify for this facility. The applicant needs to achieve triple BEE level 4 or submit a plan to achieve level 4 within 36 months, or be a 50% or more Black owned, irrespective of the BEE score, or where funding will lead to an increased capacity or job creation, must be mindful that such funding should not lead to monopolization in the metals value chain. So what the funding can be used for is modernization, upgrade of plant machinery and equipment, expansion, process improvements, working capital, development and testing of prototypes, etc. In terms of another facility that we are looking at, which is managed by the IDC, is the Agro Processing Competitiveness Fund, the APCF, to facilitate increased competition, growth and development in the agro-processing and beverage sector. Again, this is another sector-specific facility that we're managing. Applicants to qualify for this facility, they can either be a startup or an expansion. However, it excludes businesses that are in distress. Applicants must be non-dominant players in the market. Application must be within the agro-processing and beverages sector. Applicants that do not meet the IDC norms with regards to structure and debt service coverage ratio. IDC does have covenants in order for applicants to access funding. However, this facility would also look at applicants that do not meet the IDC norms. Only transactions that create new jobs will be considered. And alternatively, a ministerial directive may be issued on specific agro-processed products or markets breaking into high potential export markets. In terms of the downstream still, the instruments and pricing, the fund would look at quasi-equity and loans. The maximum is limited to 75 million per transaction. The funding is priced as follows. The first 30 million is priced at the lower of prime interest rate or IDC risk pricing less 2% for small companies. Small companies are defined in terms of this facility as companies with a turnover of up to 123 million. And then IDC risk pricing less 1.5% for large companies, where the annual turnover is above 123.5 million. And then the excess of 30 million is priced at IDC risk less 2% for small companies and 1.5% for large companies. The maximum discount period is limited to 5 years. What that means is that the facility can be priced, the term of the facility can be more than 5 years. However, the discount period would be limited to 5 years. So here, standard IDC fees would apply. This fund has exclusions. The following are excluded: pilot plants, integrated steel mills, component manufacturers that qualify for other incentives, large multinational OEMs and assemblers and their subsidiaries that already benefited from a specific government support program. With these exclusions, mainly we want to avoid double dipping so that we can assist as many applicants as possible. In terms of agro-processing competitiveness fund, the products, it would be equity, quasi-equity, as well as loans. The minimum facility would be 1 million and with a maximum of 15 million per transaction. So it is priced as follows. The loans are priced at 5%, which is a fixed rate for the duration of the facility. And then for equity transactions, it's priced at 2% real after-tax internal rate of return. And then the maximum repayment period is 7 years, including any moratorium. So raising and commitment fees do not apply. All other standard fees apply. It's not available to clients that have previously been funded under the APCF. Another facility that we are looking at is the Pro Orchard, with the objective of supporting job creation, growth in the horticulture value chain, and transformation to inter alia contribute to inclusive rural development in South Africa. The fund size is 500 million. The transaction types that the facility would look at, it will be greenfield sites, expansion, replanting, rehabilitation, and expansionary acquisitions. Transactions with economic merit and a focus on labor-intensive transaction. I think it's important that we highlight that most of our facilities, they do fund acquisitions. However, they need to be expansionary. In terms of the geographic criterion of the fund, the projects based in South Africa, with preference 60% of the 500 million given to poorer provinces and rural areas being the Free State, Eastern Cape, Limpopo, KZN, Northwest Mpumalanga, and Northern Cape. The maximum investment per transaction is 40 million. The proposed area of development must be suitable to the planned investment. Suitable techniques must be applied, such as cultivar selection, irrigation system, etc. The technical and strategic partner should have a proven track record or record of successful farming with adequate technical and marketing support from the industry. Risk sharing is critical from the strategic technical partner. Startups, expansionary acquisitions, rehabilitations, as well as replanting. Another facility that we're looking at is the Scheme for Sustainable Plastic to support the industrialization of the downstream plastic industry through the incorporation of aspects of circular economy, sector and product diversification or improvements, competitive improvements as well. So the fund size is 500 million. The maximum investment per transaction is limited to 35 million. The incorporation of aspects of the circular economy is important. More efficient usage, excuse me, of raw material. The improved functioning of the value chain to incorporate aspects of the circular economy. New products and material developments and or implementation with higher levels of recycled material. So it's looking for greater utilization of non-virgin materials, sector and product diversification or improvements, the incorporation of new plastic material into the production process, the development and or implementation of new products, and products or material diversification of companies, competitiveness improvements, modernization of plant and equipment, new or startup ventures utilizing the latest technology, as well as process improvements. Another facility that we are managing is the Agro-Industrial Fund, which is in the agro space. The objective of the fund is to support development and expansion of the agricultural sector by assisting qualifying Black producer in developing, expanding, acquiring, and integrating operations in prioritized value chains. The fund size is 1 billion. The maximum investment per transaction is 50 million. and the investment tenure is 10 years. The funding instrument, equity, which is a grant, funds need to be blended with IDC funds. The investee must be at least 60% Black owned. The acquisition of primary agricultural land parcels and of commercial viable agricultural sector value chain operating entities is encouraged. It must meet that. Support existing operations for expansions in production of privately owned or land reform funds. Brownfield and greenfield operations are supported. Funds must be used for purchasing capital equipment and infrastructure. Basically, funds should be used for CAPEX, working capital and or production loans. Okay, in terms of instruments and pricing for this facility, the Pro Orchard, the funding instruments that is used for the Pro Orchard are preference shares. The maximum term is 15 years. This will depend on the crop that is being supported. Interest moratoria is up to 4 years, also crop dependent. Capital moratoria up to 5 years, also crop dependent. The coupon is at 0%. No coupon payment required. The return is 6%. Participation rights or rights to upside be considered per transaction. The floor interest rate at prime is 3%. Standard fees are applicable. Participation rights and rights to upside to be considered per transaction. Okay. The scheme for sustainable plastics. The instruments and pricing for this facility is debt and equity. Scheme availability investment period is 5 years. The maximum investment tenure for debt it's 6 years at scheme pricing. Quasi-equity is at 10 years. The debt instrument priced at prime and prime minus 1% for companies owned by Black industrialists as well as women and youth-owned enterprises. Equity type instruments, real after-tax return of 6%, standard IDC fees apply. Exclusions, production of single-use, short-term disposable, plastic products produced purely from virgin raw material, beneficiaries of IDC, CTCP, and the Automotive Production and Development Program. And then in terms of agro-industrial fund, equity in a form of grant, funds are to be blended with IDC. The maximum tenure is 10 years. Another facility is the EIB SME Midcap Facility to assist small, medium enterprises and mid-cap companies to access loans, financing for CAPEX, medium and long-term working capital. The facility is a Euro-based facility, the size at 70 million. Applicants must meet the NACE list of eligible sectors. There is a list of sectors that are eligible for this. IDC can be contacted in relation to the NACE list. It's available to SMEs and mid-cap companies. SMEs have a maximum of 250 employees, and mid-cap companies have less than 3,000 employees full-time equivalent. So IDC is explicitly excluded as a final beneficiary. Funding is provided for CAPEX and medium to long-term working capital. The final beneficiary, the applicant or the company, and project location must be in South Africa. The total cost of a project must not exceed 25 million euros. No refinancing except for projects approved more than 6 months ago. The instruments for the EIB facility, it's loans. The maximum per transaction is 12 million euros. So we'll convert this into rand value terms. The pricing is normal IDC risk pricing less 2%. The minimum term of the loan is 2 years. Standard IDC fees do apply. The NACE list would provide for exclusions. Okay, another facility that we're looking at is the Grow Youth Fund to encourage youth entrepreneurship and employment creation by expanding South Africa's production capacity. Facility is 950 million, available to South Africans and permanent residents up to and inclusive of the age of 35 at the time of final approval. As long as the applicant is less than 36 at the time of approval, it would qualify for the Grow Youth. Youth shareholding should be at least 26%, and the youth should be operationally involved in the business. Applicants can be a startup or an expansion. They must meet the BE requirements of the IDC, which is level 4, or plan to achieve level 4 within 24 months. It has a cost per job component of 800,000 for the duration of the funding. This is calculated using the total project cost. Own contribution will be determined by the financial capacity of the entrepreneur and the cash flow profile of the business. Another facility that we're looking at is the UIF2 facility. This is a second facility from UIF. The first one, it showed success, and the partnership between IDC and PIC continued, which brought us the UIF2 facility. It's to contribute towards sustainable job creation and retention by supporting job creating transaction while providing concessionary funds. The fund size is 5 billion. Also, applicants can be startup or existing businesses, as long as they are geared to job savings or job creation. Job creation and job saving, looking at new and sustained jobs and job saved. So full details of which jobs qualify can be obtained from IDC, Financial Services Department. The UIF funds are blended at 90-10 with normal IDC risk. Compliance with UIF regulation is important. Transactions in distress, which is job saving, must not be paying dividends to the shareholders for the period of the loan. The Youth Pipeline Development Program, the objective is to improve the readiness of potential applicants and thereby increasing their probability for IDC consideration. The fund size is limited to 50 million. It's available to youth-owned businesses, irrespective of whether it qualifies for Grow Youth or not. It's for basic assessment assistance. Proposal must pass a readiness assessment and in principle go ahead from the strategic business unit head. To bring an application to bankability stage, including detailed marketing studies, mentoring, technical assessments, sourcing and negotiating with suitable suppliers, costing of products, QS costing, EIAs, etc. Up to 60% of potential investment amount, up to a maximum of 500,000. Interventions provided during pre-BA and pre-implementation stages must not take more than 6 months to be completed. Thanks, folks. The instruments for these 3 facilities in terms of the Grow Youth, it provides equity, quasi-equity, and loans. Minimum of 1 million and a maximum of 50 million per transaction. More than 26% youth-owned, it's priced at prime less 2%. Equity return of 6%, more than 50%. Youth-owned, it's prime less 3%. Equity with a return of 5%. And discounted equity pricing only applicable for the youth equity portion and fixed for a period of 5 years. And thereafter, IDC normal risk pricing will apply. First draw must occur within 1 year from date of approval. UIF, it's limited 200 million per transaction. utilizing employment intensity ratio or minimum jobs per transaction. Also, it looks at 275 million for expansionary and distress funding. And there's a counterparty limit where employment intensity or minimum jobs per transaction criteria apply. The counterparty limit is limited to 500 million. The cost per job criteria, the counterparty limit is limited to 750 million. Pricing ranges from 5.5% to 8% based on clients' development scores, Black industrialist status, and job efficiency at time of application. UIF2 rates are fixed for a period of 7 years, and thereafter IDC normal risk-based pricing would apply. The first drawdown must occur within 5 months from approval for non-complex deals and 7 months for complex deals. Standard IDC fees do apply. In terms of the youth pipeline, it's loans and grants at 50-50 and prime repayable after IDC's normal debt. It's subordinated in terms of cash flows and security. That's the end of my presentation. I hope I did well in terms of time.
Thank you so much, Mr. Hlwathi, for your very detailed presentation. I just would also like to request the panelists, and including on social media platforms, there are questions I see on the YouTube channel largely lamenting the red tape around the application process, and especially also in response to the application. One in particular, I think it's Den B. It says the red tape is the red tape of getting the application feedback is a pain and too many gatekeepers, which creates room for corruption. One from Dogozo Kuzwayo says, these youth-focused fund requirements sound good, but never translate into reality. IDC flat out wants 10% own contribution, irrespective of whether you're youth or not. Again, cut the red tape. Do you quickly want to respond to that while Ms. Tsepiso Makgoti gets her presentation ready? When you're done with your response, I'll just request Ms. Makgoti to please then unmute herself and her microphone and her video. Go ahead, Mr. Hlwathi.
All right, thanks. Shobi, please do assist me in responding to this. I think it is important that for applicants to appreciate the red tape is not there to deter them from. It's basically part of the due diligence process. We need to, as a corporation, we need to understand the fundamentals of the transactions, and also an important aspect is the repayability of the funding that we give to the applicants. So unfortunately, it can be a tedious process. Again, it depends on various aspects which are outside the control of the corporation. So we are thorough when we do our due diligence, purely because we want to understand the business that the applicant is operating, and secondly, the fundamentals of the business, including the applicants themselves. So it is rather unfortunate that the business community finds this to be a deterrent. However, it is a very important aspect of funding.
As IDC, we have a special fund that could assist clients on the contribution. And yes, we do require to see some sort of commitment from the promoters. This could be in the form of sweat capital, and through that funding, we do provide concessional equity funding that could assist the entrepreneurs. Thanks.
Thanks, Flops. I think it's very important to see the client's skin in the game. It's very important. It shows the commitment. Of course, this is, as Shobi is saying, that it could be in a form of sweat equity or in various forms. However, it's very important past experience has shown us that if there's no skin in the game from the client, those businesses would likely not be successful, and it can lead to recklessness by the client. So it is important. However, we do have interventions to try and assist clients to meet that criteria of their own contribution. Thank you, Cindy. That's my story, and I'm sticking to it.
All right, so welcome back, and we do apologize for that break in transmission. We are experiencing, as the rest of the country, feeling the pinch of the intermittent electricity supply. So we do apologize for the inconvenience, but nonetheless, the presentations will be shared with you and the recording on the respective websites. So Mr. Hlwati earlier on was just explaining the tedious and cumbersome process of having to do due diligence. It is a policy of government that governs the funding institutions and how to safeguard public funds and to ensure that the impact of the transformation funds and programs is felt in various sectors. So, Mr. Piso, if you are available, I know you're also experiencing load shedding, so I hope your connectivity is a little bit more stable where you are. If not, I'll ask Mr. Stemela to step in with his presentation. Let's start with you, Mr. Piso Makoti.
Good morning to my panelists, co-panelists as well, and to everyone that is dialed in listening to our presentations. I'm going to take you through what the National Empowerment Fund offers in general, and then we'll also speak about the partnerships that we have with the DTIC and touch briefly on some of the recovery efforts that we have undertaken since the unrest last year. The NEF was established as an act of constitution in 1998. And the organization itself actually started its operations in the mid-2000s. The NEF is the only agency of the DTIC that is exclusively mandated to grow broad-based Black economic empowerment. Our funding offers currently range from 250,000 up to 75 million. To date, just a highlight of some of the activities that the NEF has undertaken. We've supported over 1,000 transactions with a combined value of close to 12 billion rand. Supporting and leveraging further funding that's supported capital of up to 21 billion rand. We've disbursed 7.7 billion. And of that, we've already achieved collection rates of 4.1 billion. The organization itself prides itself with its integrity and has to date received over 18 years of clean audit opinions, external audit opinions since its inception, or in a row rather. The businesses we've funded support around 108,000 jobs, of which 71,000 of those were new. Currently, the NEF has a portfolio of about 23 strategic projects that have a combined value of over 13 billion rand that we are in different stages of development, from as early as scoping and feasibility, to taking them through to operation, growth, and sustainability. We've undertaken investor education, and to date have reached close to 6 million people in villages and townships through 633 different community seminars that we've held. Over and above that, we've engaged in entrepreneurship training. And so far we've reached over 5,000 entrepreneurs who require some form of mentorship training to get their businesses and their business ideas to a fundable stage. Approximately about 72% of the approved transactions emanated from our regional offices, so businesses outside of Gauteng. We do try to target your traditionally non-urban urbanized centers, so all your provinces excluding KZN, Western Cape and Gauteng. How we are currently organized is that we have 5 different funds within the NEF. We have the Imbeu Fund, which is responsible for funding our SMEs, entrepreneurship, procurement and franchise finance. Imbeu Fund typically deals with transactions that range between 250,000 up to 15 million rand. Then we have the Women Empowerment Fund. So the Women Empowerment Fund ranges across the other 4 different funds. It targets businesses that are majority women-owned and managed by Black people. And the funding ranges across the breadth of the NEF's funding funding prudential limits, so 250,000 right up to 75 million. The Rural Township and Community Development Fund supports economic development through ventures, acquisitions, and expansions. We're targeting through this fund businesses that are based largely within the agro-processing and agricultural space. But over and above that, we have supported retail centers that are located in your townships, your rural centers around the country. The typical funding for the Rural Township and Community Development Fund is 1 million to 50 million rand. With our Umnotho Fund, what we typically look at is more of the corporate types of transactions. So we do fund some startups, but largely through Umnotho Fund, we're looking at acquisitions, project finance, expansion, capital markets, and liquidity and warehousing. And the funding there ranges between 2 million up to 75 million rand. And lastly, we have the Strategic Projects Fund. This fund is typically responsible for your early stage funding, targeting mainly the manufacturing and infrastructure space. We don't typically say we have a floor within the fund, but we fund right up to 75 million rand per project, and with the potential of growing that investment once the business reaches certain operational stages. I touched on collections earlier. What you'll see is that we relatively have a stable level of collections over the last 5 or 6 years. However, with the advent of COVID in 2021, we saw quite a drop in that, and the focus was more about assisting businesses through those choppy periods as markets dried up for some time, and obviously the repayment ability of funding was rather very difficult. To date, since inception, we have seen collected around 4.1 billion rand. So what we like to talk about in determining how we price our transactions is the empowerment dividend. So we want to look at transactions that are as broad-based as possible. So, you know, the involvement of structures like cooperatives, community structures, and even your management ownership of Black managers is encouraged. The NEF is in itself a facilitator of broad-based Black economic empowerment. And as such, any equity that the NEF takes in a transaction is determined, or that portion of that funding is determined as 100% Black, 40% women-owned, and 20% designated. All equity that positions taken by the NEF, we try to warehouse them to hold them for future involvement of other broad-based Black economic empowerment groups as part of our exit strategy. The businesses that we fund, we do want to see operational involvement of entrepreneurs and management control within the operations, the day-to-day operations of the business. We also are very passionate about funding women within the space, and as we look at the empowerment dividend, more women-owned businesses are likely to attract a more favorable pricing structure from the NEF. Obviously, job creation, the different funds within the entity have certain costs, cost per job ratios that they target. Obviously, depending on the structure of the types of businesses that we look at, it's lower for your smaller businesses, whilst it becomes a bit more higher when we're talking about projects that are in development for industrial capacity, or your acquisitions of corporatized businesses. We do try to target growth sectors. However, we like to say we're agnostic about funding, about the sectors we look at. It's more about the sustainability and viability of the business, and obviously the transformation therein. Businesses that are located in non-urban centers, like I said earlier, tend to attract more favorable pricing rates, and the NEF is required to be sustainable, and as such, any risk premiums that are considered to be present in any deal would be priced into all our transactions. We also have non-financial support packages. This largely is governed by our pre-investment and socioeconomic development units. At a pre-investment level, it's the first point of contact. We have business plan solutions online, accessible through our website, which can guide and help entrepreneurs to put together business plans and even their financial models. The socioeconomic development unit is looking to really target those businesses that have the broader structures like your cooperatives, and to provide training, around savings and investments, social facilitation, but also investor education and helping people understand their role within the ownership of some of the businesses that we fund. We also do then have, after we have invested in businesses, two units, being the post-investment unit and the turnaround, workouts, and restructure. Post-investment monitors all transactions that have been funded by the unit, and we make it a point that regular site visits, at least initially and then periodically thereafter, are made by our investment associates in that unit. However, should a business experience quite difficult and trying times and require intervention, our turnaround, workouts, and restructuring units is perfectly placed to give those intervention support, help with, should there be a requirement for business rescue, finding a buyer of the assets, should the assets be determined that it's not likely to be turned around by the current shareholder. But these are some of the strategic non-financial support offerings that we have as the NEF. With respect to why the NEF exists, really is for us to address some market failures. And I think we've highlighted the market failures here that we try to look at. Obviously, within the population of Black entrepreneurs, there is limited own capital. So we tend to not be descriptive around the quantum of own contribution. However, every transaction has to be assessed for sustainability. Where skin in the game is possible, we do encourage that our entrepreneurs put in some kind of their own investment. What we've seen is that the majority of businesses that tend to do well are those where the entrepreneurs have a personal stake within that business. And then there's the limited management skills, which through our pre-investment support, we also try to, pre-investment and post-investment, try to encourage through, putting in place mentors that will help entrepreneurs in the running of their businesses. The empowerment dividend, like I said, is used to discount any kind of risk-based pricing that we put in place. Therefore, we try to ensure that our funding is as affordable as possible. Definitely, we aim to be more competitive than your traditional commercial banking service providers. And then, obviously, with a lack of accurate and reliable financial information, through post-investment, we have a back office support which allows for accountants and the finance service providers to guide our entrepreneurs to ensure that they produce reliable and trustworthy management accounts. In terms of business plans, like I said, our online portal has a tool therein that allows for people to put together business plans that hopefully can be deemed fundable, not just by the NEF, but by broader funding providers. And I would encourage our interested viewers to go in and check that out. I think it's quite a helpful guide on how to put together business plans. Part of the funding approach is that we take it upon ourselves to create linkages through the system to ensure that there is some level of bargaining power through some kind of wholesale franchise facilities, like we've had in the past with the likes of your Engine and Nando's, but also in general within the broader landscape of stakeholders that the businesses have to deal with. Our investment teams make it a point to negotiate good or better terms for all our entrepreneurs. And then obviously, with the access to local and international markets, one of our big aims is to ensure that we really enhance the export earning potential of our businesses, but also to work with those franchises and franchisors that are internationally based but are looking to establish a foothold within South Africa or grow their current presence within the country through empowering Black entrepreneurs within their businesses. So in terms of the funding that we've provided so far, some of the growth sectors that we've looked at are aligned very closely to what government does. Obviously, we speak about the Black industrialists that we have funded. 100% of our book in one way or the other supports Black-owned businesses. And as such, our funding has really been at the forefront of pushing the Black industrialist agenda. But over and above that, we're working on some strategic projects which we believe, once they come online, will have the potential of creating around 50,000 or more jobs. Supporting SMEs, over 2.1 billion to date has been injected into SMEs around the country, supporting around 500 small and medium enterprises. Our Rural, Township and Community Development Department focuses on supporting township and rural economies. And once again, about 260 entities have been funded within rural and township economies. We also are looking at investments within the property sector, and through our interventions in the last 5 years, especially, I think we've seen quite a growth in investments within the property sector. So far, we're sitting at around 103 million rand within the sector, funding businesses that are within the student accommodation, some businesses within retail property development and the like. Tourism is one of our focus areas. Currently, we actually have a partnership with Department of Tourism, the Tourism Transformation Fund, which funds businesses within that space that are transformed or looking to be transformed. And we have a number of investments within the tourism space. One notable investment is the Graskop Gorge Lift that we funded, quite an exciting adventure node within the panorama routes within Mpumalanga. Investments have been made within affordable housing, agro-processing, and energy as well. With just a focus on agro-processing, we know it's a very labor-intensive space in terms of its value chain analysis, and investments within this area we see as having the potential of unlocking quite a bit of job creation for the country. The different funds that we have available within, or products we have available within the NEF are highlighted here. I think I've touched on the majority of these funds. You'll note entrepreneurship, procurement, and franchise finance sits within the Imbeo Fund, whilst acquisition and expansion capital within Umnoto funds, and the Rural and Community Development Fund that focuses on your agro-processing tourism, mineral beneficiation and mining services, and manufacturing, and the Strategic Projects Fund, which is our venture capital fund. We currently have, over and above our Women Empowerment Fund, have a partnership with the DTIC through the European Union to fund businesses that are Black women owned, that are based within rural and township areas, and that sustain and create employment. The funding is a cost sharing funding. I think it's an 80-20 split, with the 80% that is from DTIC funds priced at a fixed rate of 1.5%, whilst the NEF funding is priced at our normal NEF risk-based funding. And whilst the maximum allowable is 10 million rand for the DTIC funds, the funds that are leveraged from the NEF obviously can be larger than the 10 million rand per application. One of our other funds is the Black Business Manufacturing Program. This is to support Black-owned SMEs that are involved in manufacturing of finished goods. Focus obviously has to be that the business must be commercially viable. We do and are allowed to fund the acquisition of plant equipment and machinery, improvement and upgrading of manufacturing processes, raw material, working capital, and costs associated with delivering under export contracts. The business has to be at least, or has to be greater than 50% Black owned, and it can be startup expansion or an acquisition. The funding is fixed at 2% per annum, excuse me, with each application allowed to be up to 10 million rand, but once again, for applications larger than that, the NEF balance sheet funding can come in and support and be blended with that concessionary funding. As at, well, post the July unrest, the NEF got into partnership with DTIC to deliver some relief for businesses that were impacted and affected by the riots through the businesses that were located or operating at the time in Gauteng and KZN. The funding made available by the DTIC was about 650 million, with the NEF putting up 100 million of its own balance sheet funding. We have since raised further funding from the Solidarity Fund, with funding of an additional 280 million. And there are some funds that, we have some funds from the Critical Infrastructure Recovery Program that is currently managed through the IBC that have been approved in principle. To date, we've approved about 860 million rand of for about 110 different businesses. These businesses have sites throughout the province of up to 170 different sites. The approvals do support the recovery and creation of some jobs of up to 7,600. And our total pipeline in the work that we've done to date is just under supporting under 25,000 jobs. Thank you. I think what we have is just our contact details for the different regional centers. We'll obviously share the presentation as Cindy has mentioned earlier. And you can definitely get in contact with our regional and our head office for any business funding inquiries that you may have. Thank you very much.
Thank you so much, Andile Stemela, for your presentation. He is the manager at the National Empowerment Fund for the Strategic Projects Fund. Andile, I'm just distracted a little bit. There's a couple of questions on the Q&A. If you and the other panelists may please attend to it. One from Raymond Jones says, does the NEF fund entrepreneurial projects that focus on beneficiation, holding contracts, and strong LOIs from reputable markets, or only focus on funding, franchising, and project models familiar to the past business models? Another one is about the application process. How long does it take from the time you submit your application to disbursement of funds? And what are the primary reasons for declining projects? While you respond to that, Mr. Stemela, may I please ask Ms. Makoti to be on standby with her presentation. Andile, over to you.
Thank you very much, Cindy. Yeah. So with respect to the types of businesses, we fund across all sectors, but in particular, we do like to fund beneficiation projects for as long as the key principle being economic viability or commercial viability of that business. So whilst our overarching mandate is to empower Black businesses, it has to be Black businesses that are sustainable. For projects which are not typically or not the typical type of business model that one would come across, like a franchise, our Strategic Projects Fund in particular looks at working with entrepreneurs to establish the technical, financial, and marketing feasibility of these businesses. That is, we would actually partner with yourselves through an equity structure, and the NEF, just as a proviso, wouldn't take more than 49%. So anything up to 49% equity is what we would look at injecting into that project. Through this early stage investment, we would then work on a feasibility study with reputable independent service providers that would work on, the technical feasibility of the business, the commercial viability, obviously through the numbers, and establishing whether there is a market and the ability to access that market given the availability of resources locally or importing certain raw materials, etc. The aim of this particular fund is to build industrial scale businesses. So, the aim is to get to a point where we have a detailed plan to set up, a well-running manufacturing or beneficiation plant that processes whatever process to produce its eventual products. What we try not to be involve ourselves in are businesses that are clearly import and distribution, and there is no value add, because then we're not really addressing the real realities of our economic limitations currently as a country. With respect to the application process, I like to say to all my clients that you're looking at an 8 to 12 week process for approval. That is from the day you walk in with a full and complete business plan to the point at which you get funding or get funding approved. From the point of approval, it's a compliance process which requires largely the agility of the entrepreneur to collect and collate all the documentation that would ensure that we've ticked all the boxes that would stand up to all audit scrutiny for any funds that are dispersed. I have seen compliance being processed as quickly as 2 weeks or a week, depending on how ready the entrepreneur is. But obviously, sometimes there may be a condition precedent within the legal agreements that requires third-party stakeholders, and that can take longer for them to produce the documentation that we would have put in as a condition. So those are the typical timelines we look at. A fine print I'll put on there is that the big difference would be with the Strategic Projects Fund, because there we're working on establishing the feasibility of commercializing a certain idea or commercializing a certain technology which exists. And that can take quite a long time, but we walk the journey together. Like I said, it's a partnership through the Strategic Projects Fund. And then with the reasons for decline, Cindy, I think deal by deal, there's always different reasons, but largely it's us establishing whether or not the business is commercially viable. And if it's not, we honestly we break our backs to try and find a way to make sure that it is commercially viable, even talking to potential off-takers of the products that the said business would be talking to try and secure some market. But if obviously that is not viable, then we have an issue. But largely there'll also be applications where insufficient information is supplied, and if insufficient information is supplied, the investment professional is unlikely to be able to make an informed decision, and this is what would impact the viability. And then one of the other reasons would be just alignment to the mandate of the NEF. Obviously, we are targeting Black-owned businesses. The only place where we would consider not looking at majority Black-owned businesses is within SPF, where the NEF itself would actually take a position within the business and hold its equity for the involvement of Black people in future. So that's how we would then, take a business that is led by someone that, is not Black as per the BE codes, and actually work to empower that business and ensure that that business in the long term becomes a Black, significantly Black-owned business.
Mr. Stimela, thank you so much. And your time permitting, there are questions that are directed at yourself or the NEF with regards to procurement of land or acquisition or investment in rural areas. One from Nati Zama and another one from Celinkosi Diaza, and many others. If you could perhaps respond to those, it's in the Q&A. And may I also request that you stop sharing your screen to allow Ms. Mahoti to then flight her presentation. Thank you so much. And it would be over to you, Ms. Sepiso Mahoti, who is the Chief Director, Strategic Partnerships and Customer Care, the Industrial Finance or Financing Division at the Department of Trade, Industry and Competition, who will give us a brief background of industrial financing, how to access financing, and what the funding opportunities are available for businesses like yourselves. It's over to you, Ms. Mahoti, and good morning. Maybe while we're waiting for the technical team, Ms. Mahoti, I think what we sometimes miss is the human element of the nature of work that we do. And, what others may seem, those that haven't had much success or joy in the application process may feel that it is only for the select few. But what happens internally is truly remarkable, because there are committees, there are people, investment associates, there are experts in various sectors, not only legal, accounting, and all these due processes are essentially there to ensure the success of SMMEs and primarily Black businesses. So I'm saying that just to give confidence to the panelists and those in attendance that it is possible. There are a number of success stories of similar businesses, if not more, that have gone through the process and have found the funding assistance and opportunities that they require. So with that, I hope with your presentation, as it touches to the access to financing, because we're not able to transform a society and create equality or an egalitarian society if we don't have access to resources and opportunities, that it will unlock those opportunities for people who are keenly looking to expand.
I just wanted to indicate, as my colleagues, the fellow panelists have said, most of the time when companies are rejected, their applications are rejected, it's not because we don't like them. Most of the time you find that it's compliance issues. And sometimes companies rush to submit applications, maybe because they think that the money will run out, they should submit as early as possible, but only to find that there's lots and lots of documents that are still, outstanding. Or sometimes they are not in the sectors that, have been, selected for that particular incentive, at least on our side in the DTIC. But we work very closely with the NEF and IDC. So, I mean, the issues that they grapple with, we also grapple with as well. And I'm glad that you mentioned we have committees like boards that, adjudicate on this applications. These are people who don't necessarily work together, who just meet once a month to come and adjudicate on the applications. And they look at applications and compare whether they are in line with the policy, with the guidelines, so that as, for instance, the DTIC, we don't encounter any audit issues at the end of the day. Otherwise, any business person can submit an application. But what I always say to our potential clients is that before you submit an application, please get in touch with us so that we take you through the process. There's a possibility that our interpretation of issues is different from yours. So you might be thinking that you're doing the right thing, only to find that we are doing something different. I'm from the industrial financing branch, where we really focus on developing, administering, monitoring, and evaluating the incentives that we provide to various clients and stakeholders. And we do this also by partnering, like we're partnering with IDC and NEF on a number of projects and a number of schemes that we provide funding for. Then can you just move on, please? Thank you. I think it's very important to note that the DTIC plays an important role in facilitating and supporting the growth of private investment, and by so doing, facilitating the creation of jobs and industrial output in general. And one of the means in which this is done is through industrial finance that is provided by the department in instances where normal market mechanisms are not sufficient to enable the development of local businesses. The role of the DTIC here really in overcoming economic challenges that face businesses. And we tend to focus on increasing the contribution of small, medium, and micro enterprises to the South African economy by financing them, and also through non-financial support. The unit that I come from, we actually focus on pre-investment, support, which we provide to different types of entities that would like to apply for incentives. We ensure that broad-based Black economic empowerment as a policy of the DTIC is implemented, And we also encourage the increase in foreign direct investment in the country, because when that happens, the jobs will be created in South Africa and many more people can be employed. And we also focus on expanding market access opportunities for the export of our goods to external countries, while at the same time contributing towards building skills, technology, and infrastructure for the economy that the enterprises can benefit from. One, I talked about collaboration that we have with our colleagues in IDC and NEF. This was just one of the few programs that we collaborated on, the DTIC COVID-19 relief funding, where funds were provided at very reasonable, cost, so that essential supplies could be provided where they were needed. And this was done via the IDC and via the NEF. And it was also done in instances where companies were in distress, and the DTIC allocated funds to both institutions so that they were able to loan out to companies that needed the money. Next, please. The initial one was IDC. The next facility was the NEF one, just to assist companies during COVID. The work of the industrial financing branch that I represent, it's done according to various clusters. We have the manufacturing investment cluster, where the intention really is to grow the manufacturing sector, and there are quite a number of incentives. Black industrialists, the 12I has come to an end. The automotive investment scheme, agro-processing support, and aquaculture development and enhancement program, the strategic partnership program, and the manufacturing competitiveness enhancement program. I wish to indicate that the MSEP, as we usually call it, it's actually being administered by the IDC on our behalf, and my colleague did talk about it, so I'll not go any further. The second one is the innovation investment cluster, where we are focusing on innovation and technology development incentives. Here we have the technology and human resource for industry program and the support program for industrial innovation. The third one is the services investment cluster, where really we are just stimulating investment, and with the hope that jobs will be created in these two industries, the global business services and the film and television production incentive. The fourth one is the infrastructure investment cluster, where funding is provided to make sure that businesses can invest, because the infrastructure that is required has been put in place through funding by the DTIC. And the last one really is the cluster where we are supporting, exports. I will start with the Black Industrialist Scheme. Here, my colleagues have already talked about the Black Industrialist Scheme. They are talking about the loan portion of it. But at the DTIC, we deal with the grant funding. We are partnering with businesses that are at least 51% Black owned. And these are businesses that in the past never had an opportunity to participate in the mainstream economy. The intention really is to make sure that we can establish a number of businesses that are Black owned, that will sort of change the structure of our economy and make sure that those who never had an opportunity in the past are given an opportunity this time. We require that such businesses should be at least more than 50% Black owned, have a valid BBB certificate, be directly involved in the day-to-day running of the organization they represent, We do not provide funding to silent partners or shareholders who are sitting somewhere, you know, and not involved directly in the business. We expect the minimum investment to be 30 million, and we fund projects that will ultimately increase jobs, or that will, you know, retain jobs that were already there. The type of funding we provide, the maximum funding for the Black Industries is 50 million. The type of funding we provide is for capital investment costs, where one can apply for instance, a motor vehicle, which would be normally a truck or a van that is registered in the name of the company. We don't fund sedans at all. We provide funding for machinery, equipment, tools, and all the things that will make the factory to run. We provide funding for feasibility, you know, studies, so that one can come up with a bankable business plan. We provide funding for post-investment support, so that, for instance, if someone was a technical person and suddenly they bought a company, they are running a company, we assist them with training, interventions, financial management, marketing, and all that, all the things that will assist the business owner in making sure that the business is profitable and sustainable. We also provide, you know, business development support interventions, where we live in an age where there are regulatory issues all over when you want to sometimes export a product, or there are sectors that are highly regulated. So we assist businesses not just to produce, but to get certification for the products, because once they have that certification, they are even able to go to other countries and showcase their products and sell them there. Thank you. Can we get to the next one, please? Next slide, please. The agro-processing support scheme. The agro-processing support scheme, here we are stimulating investment in agro-processing or beneficiation, you know, businesses. We are focusing on interventions that will increase capacity, where employment will be created, where businesses will end up using modernized machinery and equipment, so that they can be competitive and, you know, able to run sustainable businesses. But at the same time, we are broadening participation, in the sense that there are certain things that we expect that they will be procured from, I mean, raw materials that we expect that they'll be procured from Black businesses, so that the business people, the Black business people, can be service providers, and in that way they can grow their businesses. We are looking at the following subsectors: food and beverage, furniture manufacturing, fiber processing, feed production, and fertilizer production. And in this instance, we also fund machinery, equipment, and tools, new commercial vehicles, buildings. We do not fund offices, but where a factory, a warehouse, or if there's an expansion, we also do provide funding as well as competitiveness enhancing interventions that will make sure that the business is sustainable and profitable. Next one, please. Next slide, please. The Aquaculture Development and Enhancement Program that we normally refer to as the ADEP. Here we address trying to stimulate investment in the aquaculture sector and also broaden participation as well. Funding is provided to primary, secondary, and ancillary projects. And like all our incentive schemes that we have, this one as well is also a cost sharing grant up to a maximum of 20 million rand, where we provide funding for machinery and equipment, bulk infrastructure, owned land, buildings, leasehold improvements, rental costs, aquaculture feed, and all the things that will make the aquaculture business sustainable. Next, please. Next slide, please. The automotive investment scheme, we are also trying to develop the automotive sector through investment in new and replacement models and components that will increase plant production volumes and create employment. If you think of a province like the Eastern Cape, without the OEMs in the Eastern Cape, I don't know where people would be working. So funding is provided to light motor vehicle manufacturers, as well as component manufacturers who are contracted to be on the supply chain of these OEMs. The reason why we fund this component manufacturers, they get an opportunity to be on the, on the supply chain, and they get trained properly and end up producing the type of quality that is acceptable to the OEMs. And as a result, they are assured of the market. They do not have to worry. Their market is assured as long as the OEMs are there and they are producing components that will be used by the OEMs. They don't have to worry about the market. Next one, please. Next slide. We come now to the export marketing and investment assistance scheme that we use really to support exporters to explore new export markets. Here we provide funding either individually or as a group to go and to support businesses to go and showcase their products outside South Africa. I've just indicated the type of support that we fund, whether it be as an individual or in a group, and to make sure that people can go and showcase their products. And we send them 3 times to one market so that at least the first time they just get to see what is happening. The second time they start making contacts, and when we send them for the third time, we expect that they will be bringing, some orders to South Africa. Next slide, please. Now we come to the global business services, which is very close to my heart in the sense that this is one incentive that really creates employment in South Africa through servicing offshore activities. If you think of a medical aid or insurance company somewhere abroad in the UK, for instance, when people call that the contact center there, the phone is picked up here in South Africa by a young person between the ages of 18 and 34 years, which really means that the employment is being created in South Africa. And they are not just in creating employment, but creating, export revenue, which is so much required in the country. We are really targeting businesses that are in legal services, finance and accounting, IT-enabled services, and we have to make sure that at least a minimum of 3 years the company will be here. And the type of support really that we provide is really dependent on the complexity of the jobs that they do. We have the non-complex jobs, the complex and the highly, complex ones. And this incentive really assists us in the sense that it absorbs a number of young people who are unemployed. Next slide, please. Next slide, please. Yes, we have the film and television production incentive. We have 3 types of incentives here, where we are also trying to stimulate investment in making in film productions. We have the South African Black Emerging Filmmaker Incentive, where we fund them with a rebate of about 50% of the qualifying South African production expenditure. We have the foreign film and television production and post-production. These are large budget films where companies will come, film producers from abroad, come and shoot their movies in South Africa. We try our level best to keep them as long as possible in South Africa so that they can spend their money here, and they partner with local people, and our actors and actresses do get an opportunity to be exposed, and other service providers that provide services that build stages, that assist film producers also get an opportunity to provide services to that particular film. We also have the South African Film and Television Production and Co-production, where we provide funding to a South African company that would have partnered with another one abroad, where South Africa has got, has signed treaties with other countries like Canada, Italy, and all that. But the intention is really to grow the film industry in South Africa, with the hope that as it starts to grow, more and more young people will get opportunities to get employment in those movies. We've actually seen quite a number of them being funded under the DTIC. Next, please. We have the strategic partnership program, where as the DTIC, we partner with large private sector companies in order to develop suppliers' capability and capacity for them to supply these large companies. We target rather large companies with a turnover of 100 million over a period of 2 years. The intention is that they will, assist SMEs, incubate them for some time, train them, and make sure that those SMEs that have been incubated, trained, can be competent enough to supply into, the supply chain of the big companies. So as we are doing that, we are saying that at least 51%, at least 60% of the entities that are being incubated must be 51% must be Black owned. This is a win-win situation because it improves the BEE status of the big company, but at the same time, it provides jobs for people who will be supplying into, the big companies who have suddenly become service providers to that big company. Thank you. Next one, please. We have the Technology and Human Resources for Industry program that we usually refer to as a THRIP. Here we are trying to develop the human resources in South Africa for people to develop skills in research-based technology for industry, in science, technology, and such things. We focus on registered legal entities, registered higher education institutions, and registered science councils that are in partnership with private sector. What we do is to provide funding for South Africans to do some sort of research that will be solving a problem. In the past, for instance, whenever there were issues with oranges, with black spots, whatever problem we had, we were very fast to jump and call consultants from abroad to come and solve a South African problem. But with this incentive, indirectly, we are encouraging people to be in the sciences and technology, while at the same time, we are funding them so that when they conduct research, it's not the type of research that is going to gather dust at a university somewhere, but it's the kind of research that will assist industry to solve whatever problems they have. So we partner, it's a tripartite, arrangement where we partner with the business and the academic institutions where people who conduct this research are located. Thank you. Next one, please. The support program for industrial innovation that we call SPI. We are also promoting technology development in South Africa's industry. We can either do that by supporting the development of new products or processes, anything that is commercially viable and internationally competitive. And we focus on the development, phase. Here we also look at science, technology related institutions, and we also fund licensed and or registered science councils that are in partnership with the private sector. Sometimes you find that there are people who are, especially the young people, developing applications and all that. We play our role right at the beginning of the development phase, and other institutions like TIA and others, companies play another role. Next, please. The critical infrastructure program. I think right at the beginning, we talked about infrastructure that is very critical for business people to make their investments. For someone to decide when they come to South Africa, or even internal, local South Africans, they want to make sure that there's a road, there's electricity, there's water, there are telephones, and those basic things are there, so that when they do make an investment, they are sure that their business will, succeed. So we provide funding to private entities, but we also provide funding to municipalities. Like all our incentive schemes, this is also, cost sharing. And really, the amount of the grant that we offer for this incentive depends on whether this is just a private entity, it's a state-owned, entity, whether we are providing funding for someone who's in the film and television industry, where they're trying to build something that will enable them to, shoot movies, or just strategic infrastructure. It depends really on what is being applied. But the important thing to note with this particular one is that unless that critical infrastructure is there, it's not possible for investors to come in. Next, please. The other one is the special economic zones, where we really encourage investments in geographically designated areas that have been set aside for specifically targeted economic activities. We are targeting here bulk infrastructure and top structures for companies. Here we do not provide direct funding to a business, but when businesses locate the special economic zones, they are they get the benefit of tax, and they have preferential taxes, building allowance, and employment incentive. And within the SEZ, when the company is located within a customs controlled area, they qualify for more tax. For big companies, really, this is a good benefit. I just wanted to highlight the performance of the incentives that we provided during the 2020-21 financial year. 206 projects were supported, and the amount that was approved is about 8.8 billion. And this has led to a projected investment of about 27 billion. The new jobs that are going to be created, about 18, and with this type of support, we've managed to retain about 22,000 jobs. And as I indicated right at the beginning, our funding can come in the form of a grant, a loan through our sister organizations that we work with, and the 12I tax allowance that has now come to an end. This slide really shows where some of the projects that were funded came from. It's just a provincial spread of all the funding that we have done, in the past year. I don't know, you will just note that because of economic activity in the 3 provinces, Gauteng, Western Cape, and KZN, and Eastern Cape coming very strong as well, joining the 3 big metros. But we are working very hard through our strategic partnerships and customer care unit to reach out to other smaller provinces where there isn't much economic activity getting on. We go to, in the past, we just used to visit the big cities, but we are now going to the rural areas, because we partner with provincial agencies, and they make arrangements on our behalf to meet business people in their areas so that we can take them through what we offer and they can ask questions. So we hope that this financial year, this coming financial year, things will improve, especially for those smaller rural provinces that didn't seem to get much of our incentives. Here, it was just to show that over and above the critical infrastructure and the IDs, we also provide funding for our industrial parks, where we are promoting development in rural areas. The parks are being revitalized. The only sad thing is that after that investment into the parks, people come and vandalize them. But we are partnering with provincial bodies to make sure that this does not happen anymore. I specifically made this slide just to assist people to say, now that we're coming to the end of the presentation, I will invite those businesses that are interested in accessing our incentive schemes to please get in touch with us, not hurry to submit applications. Let us explain the terms and what is meant in our guidelines, so that by the time applications are submitted, they get it to the system. People know exactly what is expected of them. When all our applications are there on the website, and we expect that one will complete and submit a completed application together with the necessary documentation. And the applications are assessed, evaluated. If there's outstanding information, the business person will be contacted and given a time frame within which additional information will be submitted. Otherwise, if all the information is complete, the application will go then from the technical committee to the adjudication committee that consists of different people who are not necessarily working with the applications at all. The application can either be approved, rejected, or referred back for additional information or just for clarity. And the decision of the adjudication committee is final. But having said that, if one feels that they should not have been rejected, or they have some new information to provide, they are allowed to do that within a period of 30 days, and that can be reviewed. Whatever decision the adjudication committee makes, it will be done in the form of a letter. Whether it is approved, rejected, or referred back, there will be a letter that stipulates whether if someone was approved, what are the terms of engagement with the DTIC and all that. The difference is only with the black industrialists that I talked about at the beginning. With the black industrialists, we actually insist that potential applicants get in touch with us through the BI inquiries at the dtic.gov.za and submit their inquiries there, including whatever documentation that is listed that we'll have to review before they can submit our application. This is an extra step that is taken to ensure that those who apply have a better chance of complying with all regulatory requirements. Remember, we are governed by the PFMA and many other, government policies that we have to take into consideration when we are handling taxpayers' money. And that's why it's so important that once this is done with the black industrialists, they will receive what we call a BI inquiry number, and then they would utilize that BI inquiry number to submit an application to the BI applications at the dtic.gov.za. And on that note, I think I will say thank you very much. This is where we can be contacted. But if you look at the DTIC website, you will see that over and above these contact details that we've provided here, for each incentive scheme, there are contact details that are provided there so that we can assist, we can assist as many entrepreneurs as possible. There are many different reasons, like the one that I mentioned right at the beginning. It's a compliance issue. If I could just make an example, if you want to go to medical school, you definitely have to pass maths and science. So here, in the same way, there are certain regulatory, compliance issues that need to be met in order for people to, qualify for the incentives. There are instances where people think that the minimum investment that they have to make is too high for them, and they are unable to meet this. But you'll recall that I think it was in 2014, the DTIC was divided into DTI and the Department of Small Business Development, so that target market could be assisted by the Department of Small Business Development. There are instances where very small businesses come to the DTIC, and unfortunately, with the instruments that we have, we cannot assist them, but we always refer them to our colleagues in Department of Small Business Development or the agencies that we work with. There are instances where somebody will just want to be funded for cannabis. We cannot do that currently because we are still waiting for the regulations, the rules and regulations by SAPRA. And we cannot give out taxpayers' money to a sector that is not yet properly regulated. On one side, government says this, and on our side, we say this. So we need to wait for the sector to be properly, regulated so that we can provide funding. So it's just a myriad of, reasons that are provided by people. But what I would like to say is that we do not look at the faces of people. Most of the people that we deal with, frankly speaking, I don't even know. Maybe I've met online, or we've met once or twice in a meeting or in a workshop somewhere, but I can't even remember the people. All what we focus on is whether the money that has been allocated by National Treasury is being used for the purpose it was, designed for. That's all we look at.
I think it would be pragmatic for us to wrap up and continue, hopefully, with the next session that we'll have to really unpack the various products. But the sense I'm also getting is that there is a system. It may not be ideal or perfect, but it does work if you comply with the rigorous process of the qualifying criteria, and also seeking assistance, getting clarity from the principals as to how your application should be submitted. So with those words, I really like to thank you for your interest and participation in the Industrial Funding and Incentive webinar. And engage with us on our websites. We are NEFCORP, that's nefcorp.co.za, and you can also follow the DTIC and IDC. From myself, Cindy Mabi, be abundantly blessed. Thanks so much for joining us.